Experts webinar today. Please let me start by introducing myself. I'm Ellen Smith, Managing Director with Riveron. I know we all are very interested to hear what my colleagues have to say regarding demystifying fair value. For those of you unfamiliar with Riveron, Riveron is a business advisory firm specializing in accounting, finance, technology, and operations. We partner with our clients to successfully prepare for and execute change across the entire transaction and business lifecycle. A fun Riveron fact for me, when I joined Riveron almost 10 years ago, we had about 40 people in 2 offices. Currently, we have over 500 people nationally in 14 offices. We have a fabulous panel today. Please let me introduce you to 3 of my colleagues who are experts in due diligence, valuation, and technical accounting matters. Mike Dunkel is the Managing Director in our Washington, D.C. office. Dave Marquardt is the Managing Director in our Chicago office. And Jason Lloyd is the Director in our Chicago office. Before we move on to the content of our presentation, a few key reminders. On our website, riveron.com, you can all access our previous Ask the Expert webinars, as well as a number of key insights on accounting, reporting, and operational topics. This webinar is scheduled for May 6th, which will kick off our SPAC and IPO series, so mark your calendars for that. During the webinar, we will include 4 polling questions, which must be answered to be eligible for CPE. Please make sure to enable all of your pop-ups. If they are disabled, you will not see the questions. Also, we welcome any questions you may have. There is a Q&A option in Zoom. Please feel free to post your questions there. We will try to get to all of your questions during the seminar, but if we don't, we will respond separately. The webinar evaluation form and CPE certificate will be emailed to you within 2 weeks following the webinar, along with access to the deck today and our contact information. Please note that while the on-demand video will be available on our website, the on-demand version is not eligible for CPE. So with that, let me kick off our session with our first polling question. When evaluating a target acquisition, how do you value a business? A, intuition approach, B, income approach, C, comparable approach, or D, throw a dart option. Jason, while we are waiting for the polling questions to be answered, when Riveron is engaged to prepare a valuation, what approaches do you normally take?
Hey, Ellen, thanks. Yeah, so when we're looking at this from a fair value perspective, we would try to apply as many approaches as would make sense. So essentially, if there's decent information to provide a discounted cash flow analysis or a market approach, we would apply both those approaches.
Excellent. Well, let's see what the answer to our polling questions are. Well, our group largely says income approach or discounted cash flows. Why don't you, Jason, jump in and discuss the fair value concepts that you would apply here?
Sure, thanks, Ellen. So, in the beginning of the presentation, we're going to talk about fair value concepts in terms of what fair value is and what it isn't, and then talk about the 3 generally accepted methodologies for determining fair value. So fair value, it's very much a financial reporting concept. So it's really developed to provide transparency into fair value measures as it relates to a company's financial statements. So if you think about valuing a business or a specific asset, there's a lot of significant assumptions and judgments that go into that estimate. So talking about from a financial forecast perspective, revenue growth, profitability assessments, discount rates, and required returns. And what the fair value framework is really trying to do is provide a systematic approach and guidelines to make that assessment. So as we think about the fair value definition, the key term here is market participant. So a market participant is, a likely buyer in the industry and the assumptions that they would use. So if you compare that with, a company specific or an investment value, that's really the angle that a specific company and how they would assess the value of an entity or an asset. So for example, if a company is by large the largest company in the industry and they have purchasing power and economies of scale, that others wouldn't be able to achieve in the industry, that's great for their investment thesis, and that's how they would approach making a potential transaction. But when we look at fair value, we would have to exclude that type of scenario from a financial reporting concept. So when we think about who a market participant is, the FASB really does define and gives us context for who that is. So as we see at the bottom of the slide, that person is independent, so they're not biased, they're knowledgeable, they have the facts in front of them to make a sound investment decision, and they're able and willing to enter into the transaction. So, a light example would be if you're determining and we're asking you, well, how did you come up with $500 million? And you say, well, my neighbor Bob liked the idea and he would pay me $500 million for it. Bob might not have the financial wherewithal to actually enter. So that's not really a fair value concept. So additional concepts within fair value is exit price. So really, what would be the price received for selling an asset or a business under current market conditions? So even though you might have made a transaction a year ago, you do need to assess that periodically for what's going on in the market today. So if there's been impacts to the industry or a wholesale shift in the industry, you would need to take that into consideration in terms of your fair value. And also, as we talked about, it differs from investment value or company-specific value. So for example, in one project we were working on, the client, we were going through their forecast, and they had a revenue line item that just said other, and it grew pretty significantly over the time period. So when we were inquiring about what that is, that really uncovered that that was just something that they put in to be able to justify to the board the purchase consideration. So it really wasn't founded in the economics of the business at all. So obviously that's not necessarily a fair value concept. It's great for them to be able to make their investment thesis, but from a fair value perspective, that would be excluded from the analysis. And a little bit of trivia is fair value concept was really born from the Prohibition times when breweries were shut down and had to be paid fair value for their business. So next we'll talk about 3 generally accepted approaches for determining fair value. The income approach, which going back to the polling question, looks like quite a few people use that in their assessment. The market approach and the cost approach. So the income approach is really based on the future economic benefit generated by a business. So the earnings stream that you expect in the future from a business. The most common application is the discounted cash flow model, which we'll talk about here in a second. But the income approach is also used in terms of valuing intangible assets. So if you think after an acquisition, you're setting your opening balance sheet and you have to value all the assets acquired, the income approach is used in valuing those intangible assets, and we'll cover that at the end of the presentation today. The market approach is based on trading prices and transactions for similar or identical assets. So when it comes to valuing a business, you would look at comparable companies that are publicly traded and look at what they're trading at. And it's really the comparison and correlation between those public companies and the company that you're valuing, the target company. And finally, we have the cost approach. The cost approach is really based on the concept of replacing a reproduction cost. It's not generally used in a business enterprise valuation. If you think about it from the concept of like a software company, the value of a software company is the ability to continue to generate revenue and income based on licensing that software, not really the cost that it took one to create the software. So when we look at the income approach and the discounted cash flow analysis, what we're doing is really forecasting the future economic benefit. So in this case, in terms of a business, that would be free cash flow. So we define free cash flow as you walk down the income statement, expected revenue minus cost of goods sold, operating expenses, and depreciation, tax affecting the result to get to earnings after tax, and then adjusting that for non-cash charges, so adding depreciation back, adjusting for any sort of change in net working capital. Generally, as revenue goes up, you would expect there to be incremental working capital needs, which would be a deduction from cash flow, and then take into consideration any sort of capital expenditures need in terms of machinery and equipment, furniture and fixtures, and the like. So once you have the financial forecast generated into the future, what you need to do next is discount that back at an appropriate discount rate. And again, here, what we're talking about is the difference between investment return and a market participant return. So a lot of times when we're working with clients, they might have an internal hurdle rate of how they assess a transaction, or they might use their internal borrowing costs as their discount rate. When we talk about fair value, we're really looking at the market participants, and what we're looking at there is a weighted average cost of capital, which is the return on equity and debt holders weighted based on their proportions in this capital structure that's prevailing in the industry. So here we might take 10 comparable companies, and if the average capital structure would indicate 30% debt, 70% equity, we would generally use that in our fair value analysis for financial reporting purposes. Next, we'll touch on briefly on the market approach. Two common methods under the market approach are the guideline public company method and the guideline transaction method. They're both very similar in that you're looking at multiples being paid for items in the marketplace. So from a public company transaction method, we would be looking at market cap plus debt to get you enterprise value and dividing that by some sort of financial metric, typically revenue or EBITDA. So the key with the guideline public company method is to do your homework and make sure that you're doing a full comparison of the target company relative to the comparable companies. You just don't want to take a simple average and apply that. If we're looking at a target company that is growing faster or is more profitable than the average company in the industry, you want to make sure that you're adjusting your multiple to reflect the value that would be added there. And similarly, the guideline transaction method, similar concept, but here we're looking at companies that are being acquired and looking at the purchase price divided by those financial metrics. So at the bottom of the slide, you can see a simple example is, after the analysis, it was determined that the median 8x EBITDA multiple is appropriate, where we have $10 million in EBITDA, and it's simply 10 million of EBITDA times an 8 multiple that would indicate your enterprise value is 80 million. So with that as a backdrop, I'll turn it over to Ellen for the next polling question.
Thanks, Jason. Our polling question is, was financial due diligence conducted prior to your most recent business acquisition? And if yes, by whom? A, yes, by management. B, yes, by a third-party advisor. C, no financial due diligence was performed. Or D, what is financial due diligence? Which is a great question. Mike, while we're waiting for our responses, what are some reasons our clients benefit from actually having financial due diligence?
Well, we're going to get into a lot of that during our discussion here, Ellen, but I think overall, a lot of a deal thesis by an investor is academic. It's on paper. A lot of it has to do with external information that goes into an LOI. And then financial diligence is really where, at least as it applies to enterprise value, it kind of gets hit with all the real world facts and everything that's specific to a deal, since we know no two deals are the same. So it really kind of helps bridge those two views.
Gosh, thanks, Mike. And we'll look forward to hearing some more details. Our respondent said, yes, they do conduct financial due diligence and engage a third-party advisor. So, which is great news because it sounds like we have some Riveron clients on here. Mike, you want to tell us a little bit more about the financial due diligence process?
Absolutely. Thanks, Ellen. I'll start just with diligence in general. Let's just kind of think about the question of what is due diligence. Due diligence in general is a detailed investigation of a target company, typically for an investor, can also be for a lender or some other type of sponsor. Specifically, financial due diligence, it's very much focused on the financial metrics that are related to enterprise value, or in other words, fair value that we're talking about today. Financial due diligence is not a valuation. Sometimes there is a misunderstanding about that, but it is a common method to independently validate a given level of value. And we do that based on basically pressure testing the metrics that are really supporting a level of fair value. Additionally, financial due diligence seeks to identify risks and understand the target company's performance and position. The focus is historical. And this is another key thing to keep in mind. It's just very much a historical view which can be proven versus a forecast view that is related. However, there's a lot more uncertainty. So what we often will see done is really a bridge of the outcome of financial due diligence and other diligence areas as well to the future, so that we can see if we're really dealing with apples to apples expectations or apples to oranges, and it's really a stretch goal, and maybe something needs to be revisited at the deal table as a result. So moving on here to talk about how does due diligence, specifically financial due diligence, relate to fair value. So as Jason discussed in the market approach, investor value or fair value, these are the terms and the levels of value that are comparable to enterprise value. And that's really from an academic perspective. Enterprise value is often arrived at by using comparable transactions in the market. Those comparable transactions can be broken down into multiples, typically by industry, and those multiples are often applied to adjusted EBITDA. So how do we arrive at adjusted EBITDA? Typically, this is where financial due diligence and specifically a quality of earnings analysis comes into play. A quality of earnings analysis assesses various performance aspects which impact EBITDA or the comparability of financial information, and it helps validate that fair value. So as you'll see in the coming graphic here, enterprise value and what we assess as part of a quality of earnings is not the same as purchase price. So you'll see at the top here, we take the output of QV, adjusted EBITDA, and we multiply that times a multiple. So in other words, you could say, let's say that EBITDA is found to be $10 million on a recurring basis, and a multiple in industry is, so 10 million times 10 would be 100 million of enterprise value. But that's not the same amount that changes hands as part of the purchase price. So typically what you have there is changes in that amount of cash that changes hands at closing for how much cash is left in the business, how much debt is left in the business that needs to be paid off, debt-like items, which may be on or off balance sheet, and they're not necessarily interest-bearing debt, but they would be something that's the obligation of the seller, and also extraordinary items and transaction costs for advisors like ourselves, which would typically come out of proceeds. And then you have a working capital adjustment, which we can hit on later here, but that is a high-level basic purchase price calculation that is sometimes referred to as a waterfall that gets you to the actual purchase price that may then be disclosed. So moving on here to talk about kind of how buyers and sellers start their negotiations, it's always assuming that detailed performance results and forecasts support a bid or a given level of value that's stated in a letter of intent. But those expectations can often be pretty optimistic, which I'm sure many of you have seen before. So a lot of times the outcome of financial due diligence can change the assessment of the target company and what it might be worth to an investor. And I'll ask Jason to kind of speak up here to chime in on this, but you'll see in the chart, this bridge in the lower right, that on the left you have the academic view of fair value and how that was going to fall out to $8 million. And on the right, a different level of EBITDA that would have been post-diligence come out to 64 million. So those are not always the same, and you have options there. Jason, maybe you have some input on that.
Yeah, Mike, what we often see is we're working with our clients is usually the starting point for a transaction is the target entity is going to provide them with a financial forecast. And that's really what the graph on the lower left-hand corner is representing. Typically it's pretty rosy. They're the greatest thing since sliced bread, and they're going to grow, 10x over the next 5 years. So, you always have to take that with a little bit of a grain of salt there. So when our clients are really assessing it, they're looking at, well, what's really the inputs into that forecast and how do we temper them to get something more realistic? And then the other aspect of it is, to your point, they're doing their due diligence and looking at, well, is the historical run rate of EBITDA appropriate or how that should be adjusted? And there could be, one-time costs, recurring, maybe they're going to lose a specific client, or maybe a project won't continue going forward that they didn't necessarily make transparent in their forecast when they turned that over to a potential acquirer. So you see in the lower right-hand corner there, by going through diligence and identifying various adjustments, you really get to level set to what a realistic expectation for EBITDA is. And you can see in this simplified example that these are real world dollars. It's going from 80 million to 64 million in terms of what a potential purchase price would be.
Thanks, Jason. And maybe we can now hit on what else does due diligence cover, since we were just referring specifically to financial due diligence. It is very common for us as advisors and many other firms to also cover areas such as tax, IT, and operational diligence. And that would typically be in addition to what one of our clients or an investor would be looking at from a legal, commercial, and sometimes HR and other areas. To kind of address these just quickly, these are very standard practice nowadays. I think a lot of times sponsors and reps and warrant insurance providers will expect that diligence was done on non-financial areas, and all of them can impact the purchase price, either directly or indirectly. Directly would be, as an example, we have had a client just recently find that there was a lack of ability to realize synergies, a lack of an ability to cut out back office that was planned for. So that really meant that EBITDA was decreased, and that came out of some very detailed views of the operations of the company and their systems. So that would actually decrease the purchase price and be something that our client, the buyer, would negotiate with the seller. An indirect example there would be when a potential tax obligation is found that really doesn't change EBITDA, but it could absolutely change how much money needs to be held in escrow by the seller and could potentially be due to authorities. So that is an example of something where the purchase price may or may not be reduced as a result, and the cash exchange hands and actually flows into the seller's bank account at close would absolutely change. And just to kind of go back to financial due diligence, which is the focus here as it relates to fair value, we've been referring a lot to adjusted EBITDA. This is the metric that obviously is most applicable to valuation multiples, which are typically by industry. In other words, certain industries like technology have much higher multiples than perhaps some of your lower middle market manufacturers. And these levels of adjusted EBITDA come from the quality of earnings analysis like we discussed before. But there are other areas of financial due diligence that could impact the ultimate purchase price. During a typical diligence scope, we're also looking at a target company's financial position. So in other words, how healthy are its balance sheets at points in time specifically. And we also look at a target company's cash conversion performance, which is really the metrics that relate to working capital management. Separately, we look for on and off balance sheet obligations that are uncovered, and our goal is to quantify them. And that way it really helps to understand what should be defined as indebtedness in the sales and purchase agreement. Lastly, we also look at accounting processes and the target company's ability to produce quality information, which can both help validate buyer and seller expectations. It can also do the opposite and actually create some cloudiness that a buyer may or may not exploit. So moving on to talk about the scope of financial due diligence for all of you that I'm sure are so excited to get involved to hire a diligence advisor at some point. These are the areas that I would recommend you really kind of could just use this as a tear sheet. This is really what should be included in a full scope diligence. We talked a little bit about quality of earnings, and we talked a little bit about working capital, but in addition to cash conversion with working capital, a good working capital analysis should also help a buyer develop a target level. In other words, a level that the seller needs to contractually agree to deliver at closing in order to basically not allow the seller to extract too much cash from operations before close. So that's an important area. We also look at capital expenditure requirements and other areas that really impact operating free cash flow, but would not have been included in EBITDA. So they're kind of outside of the quality of earnings, but very important to running a model for future cash flows. We talked about debt and debt-like items. And then lastly, business operations. It's very often that the KPIs that relate to EBITDA or relate to margin trends need to be assessed separately. And those can also result in impacts to enterprise value or the purchase price. Examples would include average direct labor, capacity, utilization, speed of activity, etc. And we can also just kind of bring up that, especially when you start to look at different industries, there are a lot of other diligence areas that really need to be assessed outside of the bread and butter items. For example, in the upper left here, you see quality of revenue versus quality of earnings. That's very different and very related to healthcare. And it has to do with looking at collection curves and massive data sets to understand the net amount of cash that should be collected by payer group, by geography, and by demographic. Another example would be a synergy analysis. A lot of times that requires an operational view, and that's not something that those wearing the accounting hats performing kind of plain vanilla quality of earnings would be covering. So all of these are areas that a firm like ours and many others will sprinkle into the scope to really ensure that the deal thesis is adequately pressure tested. So to wrap up the financial diligence section, we can talk a little bit about best practices. From our experience as transaction advisors, financial due diligence is critical in most middle market and above deal sizes. Integrating financial due diligence with other functional areas such as tax, IT, operational due diligence, and even a fair value assessment as you're coming to what we're about to talk about with purchase price allocations and accounting. All of that is really ideal to work streamlined together. In other words, advisors using the same request list, same catch-up meetings, same prioritization of what can impact the deal value. Typically, you're on a pretty short timeline of exclusivity, so there's a lot to get done. And we also recommend that a continual assessment of the original fair value and the ultimate purchase price that will fall out in the waterfall is continually looked at while conducting financial due diligence. This is really how you drive value from your advisors. What that means is that it's ensuring that all the results of this deep investigation that you're paying for actually make it into negotiations, and then the representations and the terms of the sales and purchase agreement, and also the details required for insurance policies, and also the closing mechanism. You know, all of those things should never be just a canned approach. You really want your diligence outcomes to impact those in a way that either mitigates risk for you as an investor or perhaps even exploits value from the seller. So with that said, I think we can move on to our third polling question. And Ellen, I'll pass to you.
Well, Mike, that was really informative. Let me confirm now that everyone is still listening to us. In your most recent transaction, who prepared the purchase price allocation and opening balance sheet? A, third-party diligence advisor. B, acquired CFO or controller. C, an accounting firm other than the auditor. D, I don't know because I was not involved in the transaction. Hey, Mike, while everybody's answering our polling question, I was reflecting on your presentation, and you outlined the typical scope of financial due diligence. Who usually helps select those scope of services, and what drives those?
It's definitely a client and advisor collaboration. I would say that's in the interest of both parties. If either side demands a plain vanilla canned approach, walk away. I would say that, you know, it's on an advisor to tailor things based on their experience, and it's also on a client or an investor to be very pragmatic about what they need and the fees that relate to those scope services.
That was really helpful. Thank you, Mike. Well, our answers are in, and the majority of our guests have said they utilize their acquirer, CFO, or controller, which is really interesting that the majority does not utilize a third-party diligence, but the majority does use an outside advisor, either a third-party diligence advisor or an accounting firm. So that's kind of an interesting response from our people. Dave, again, we've talked about fair value, and Mike's talked about due diligence. I think it's appropriate now to kind of address the purchase price allocation considerations.
Yeah, thanks, Ellen. And so typically after Mike and the team have completed their financial due diligence, the buyer and the seller will finish their negotiations, and let's say they successfully close on a transaction. When there has been a change in control, such as when a buyer acquires a business, accounting rules require that the purchase accounting method be performed to properly account for a business combination in the buyer's financial statements. So in this section and in the following section, we're going to discuss some of the basics of the purchase accounting process, including where fair value concepts come into play when determining the total purchase consideration transferred to the seller, as well as how that is then allocated to the net assets of the business acquired. As illustrated at the bottom of this slide, one of the first steps in the purchase accounting process is to determine the fair value of the total purchase price or the consideration transferred to the seller for the business. Then the assets acquired and liabilities assumed are identified, and generally their fair values are determined. Next, the purchase price is allocated to the identifiable net assets based on their respective fair values. Once the allocation of the purchase price to each asset and liability has been accomplished, the residual or the excess purchase price paid is recorded as goodwill. The purchase accounting disclosures and financial statements should then provide the reader with an understanding of the business combination, how much consideration was paid, what was acquired, and the respective fair values of the acquiree's assets and liabilities. And after allocating the total purchase price, how much excess consideration paid resulted in goodwill. Let's talk more about how the purchase price is determined. And this may seem simple, but the total consideration transferred in a business combination is often more than just the cash paid to the seller on the transaction closing date. In other words, as illustrated here, the purchase price is the sum of the acquisition date fair values of the assets transferred, liabilities incurred by the buyer to the seller, and any equity interests issued by the buyer to the seller. So the purchase price may include not only cash, but other assets, equity issued by the buyer, contingent payments, deferred payments, and other purchase price adjustments, for example, a working capital adjustment, among other things. In summary, if the consideration paid or payable to the seller of a business includes anything other than cash, the fair value of the consideration must be determined as of the acquisition date and included in the total purchase price. So for example, if contingent consideration, such as an earnout provision, is involved, the acquisition date fair value of the contingent payments must be determined and included in the total purchase price. Therefore, it's important to not only consider the funds flow or the wires of cash paid to the seller at closing, but to also understand the nature of the transaction and to carefully read the executed purchase agreement to identify all of the components of consideration transferred or payable to the seller. The next step in the process is to identify the assets acquired and liabilities assumed. And again, this sounds pretty straightforward, but care should be given in analyzing the seller's closing balance sheet and properly identifying what is being acquired by the buyer, including assets and liabilities that may not have been recorded on the seller's closing balance sheet. A complete understanding of the transaction is necessary in order to do this. For example, whether the acquisition is a business that has been carved out of another entity of the seller versus an acquisition of common stock of an entity, those two different situations can result in differences in terms of assets acquired and liabilities assumed in the deal. It's also useful to understand the nature of the business in order to properly identify all of the assets acquired and liabilities assumed. With some limited exceptions, the assets and liabilities of a business acquired are recorded at their acquisition date fair values, and common types of assets and liabilities that the buyer may need to fair value at the acquisition date may include inventory, fixed assets, intangibles such as customer relationships, trade names, off-market contracts, as well as contingent consideration, debt, and certain other liabilities assumed. So to properly identify the fair value of the net assets acquired, it's helpful to leverage what is also learned about the business during the financial due diligence exercise. Before discussing some of the general valuation techniques used to determine fair values for certain assets and liabilities, let's take a couple of minutes to summarize through a simple example of the purchase price allocation process. And here, just some background information. Let's assume company A acquires target B, which is a distribution business. And at closing, $85 million in cash is wired to the seller. Because the buyer and the seller could not agree during negotiations on the estimated value of the business, the purchase agreement also includes an earnout provision that provides for additional payments to be made to the seller at each of the end of the next 2 years, contingent upon the achievement of certain EBITDA metrics. And let's assume that the seller will not be involved in the business post-transaction and that management of the acquired company, acquirer, and their accounting advisors have determined that the contingent payments should be considered as part of the purchase price as opposed to compensation expense to be paid to the seller. And the purchase agreement also provides an adjustment of the purchase price if actual working capital existing at the acquisition date exceeds an estimated working capital amount determined pre-close during financial due diligence. In this example, let's assume the net working capital adjustment turns out to be an additional payment of $1 million to the seller. And a valuation specialist determines that the fair value of the earnout or contingent consideration in this situation is $14 million at the date of acquisition. So that means that the total fair value of the consideration transferred to the seller of target B is $100 million. And company A, as the acquirer, must then perform an allocation of that total purchase price. And so they identify the assets acquired and liabilities assumed in the acquisition of target B, including intangible assets which could not be previously recognized by the seller. In this case, it's customer relationships. The assessment of the valuation specialist also determines the fair value of the net identifiable assets acquired and liabilities assumed. And then company A allocates the fair value of the total purchase consideration to the identifiable assets acquired and liabilities assumed, which results in this situation as a step up to the tangible assets, the recognition of customer relationships as an intangible asset, the recognition of contingent consideration as a liability, and the residual or excess purchase price recorded as goodwill. So in a purchase price allocation, I think the key takeaway is it's important to understand the nature of the transaction, the business, and to also reconcile the sum of the fair values of the assets acquired and liabilities assumed in the business combination to the total purchase price. Ellen, I think we're ready for another polling question.
Sounds great, Dave. Polling question number 4. What are the biggest challenges in determining the fair value of an acquiree's assets and liabilities for purchase accounting? A, gathering the right data inputs. B, using the right methodology. C, getting the auditors to sign off. And D, all the above. So I use a valuation specialist to do this. Hey, Dave, we've talked about fair value in due diligence. In this purchase price allocation, do our clients often struggle post-transaction with purchase price allocation?
Well, Alan, I think that, as we mentioned, it's the details are important to pay attention to. And so it's critical to understand the nature of the transaction, to carefully read the purchase agreement, to understand the step plan of the transaction, how the business combination is structured, and then to also understand the nature of the business so that the appropriate assets and liabilities acquired are identified, and those that are identified are properly fair valued so that the purchase price can be properly allocated in the purchase accounting exercise.
Well, that's great. I appreciate the insight. Well, the results are in, and Dave, the majority of our guests say that they do use the valuation specialist to help them determine the fair value of an acquirer's assets and liabilities for purchase accounting. Hey, Jason, since everyone agreed that a valuation specialist is necessary, would you please share some common insights about common valuation methods?
Yeah, absolutely, Ellen. Thanks. And glad to see that people are using valuation specialists, in my unbiased opinion, as a valuation specialist. So here we're going to talk about the basics in terms of valuing an intangible asset. And again, we're talking about you've evaluated your target, you've consummated the transaction, and you're identifying, the steps through the purchase price allocation in terms of, the accounting treatment and then the fair value opening balance sheet adjustments. So here we're going to talk about the common methods used. So the table at the bottom of this slide talks about the typical intangible assets that we might see in a transaction and the general valuation methodology used for those. This does vary by company, by industry, and it's all dependent on the facts and circumstances of your industry. For example, if you look at a company or an industry like a pharmaceutical industry, there is generally no customer relationship asset recognized because if you're a pharmaceutical company, you don't have a relationship with that end user, so you're not engaged with them, and there may not be a repeatable buying pattern associated with that. Same thing in a consumer products type company. So think about food products or snacks or what have you. Typically in that sort of industry, you have distribution relationships rather than customer relationships. So it's a little different angle and approach. But the way that we determine what methodology to use when we're looking at the valuation is really this concept of primary asset. So if you were to step back and look at all your intangible assets, the primary asset is really considered the asset that you're acquiring the company for. So for example, if you're looking to gain market share and you're buying a competitor that maybe does business overseas or in a region that you're not in, generally the customer relationship would be your primary asset in that situation. If you're looking to enter into a new industry and the technology is really the game changer for you, then that technology asset is going to be your primary asset. And this isn't hold true for everything, but generally your primary asset is valued using an excess earnings approach. So on the next slide, we can walk through the three typical income approaches used when valuing an asset. So talk about it in terms of maybe the easiest conceptually to understand to the most difficult. So relief from royalty, this is generally used for intellectual property like trade names and patents and certain technologies. So the concept here is that as an owner of the asset, you are relieved from having to pay a royalty. So this hypothetical savings to you is really the value derived by the asset. So the key inputs when looking at a relief from royalty methodology is the projected revenue. So if you're thinking about a trade name, what are the projected sales of the products that would use that trade name? Then as it relates to technology, there would be this concept of obsolescence. Obsolescence is really accounting for the change in technology over time. So if you think about it from a purchase standpoint, you're valuing all your assets as of that acquisition date. So as the technology changes, if you think about Microsoft Office Suite or the iOS on your iPhones, you're constantly getting updates. So someone behind the scenes is changing that technology and it's evolving over time. When we're looking at it from a financial reporting standpoint, you only want to capture the value associated with what you bought at a point in time, and not really the incremental value that you will add as you continue to do developments on an ongoing basis. So there's this concept that there's obsolescence that needs to be captured, which essentially lowers the fair value of a technology asset. The key input here in terms of relief from royalty is the royalty rate. So here what we're looking at is reviewing market agreements, so what people are actually transacting for similar assets in the marketplace, qualitative assessments, so it might be a brand study or strength of brand, how you compare to other brands in your industry, and then profitability metrics. And by that, if you're earning a 10% margin and you think you should be paying a 15% royalty rate, obviously that wouldn't make sense economically, because essentially you'd be giving away all your profits in that situation and have a negative 5% margin. So the last concept here, and this gets back again to what we talked about at the beginning of the presentation, is the intended use of the name or technology. So a lot of times acquirers will want to essentially rebrand the acquired company or the products and put everything under one umbrella. So it really goes to the facts and circumstances here again. If you're acquiring a smaller tuck-in acquisition and the name isn't generally known in the industry and it doesn't have a national presence, for example, then it's likely that a market participant, being a larger, more established company, would want to essentially sunset that name and put everything under their umbrella. So that's a common assumption we have to work through in terms of a purchase price allocation or evaluating a trade name. And then again, we talked about discount rates at the beginning of the presentation, just in terms of what's an appropriate rate. And generally here, we're looking at the weighted average cost of capital and any sort of potential premiums to account for the risk associated with the trade name and the forecast. Next, we'll talk about the with and without method. This methodology is typically used to value non-compete agreements. So it's looking at a comparison of a forecast for a business with all the assets in place, which is generally your base business forecast. And then you're looking at a scenario where the asset that you're valuing is no longer there. So if you think about it from a non-compete, if you have a key sales team or an innovation leader, they decide to leave the business, how would that impact the company? Would it take away, in terms of like a salesperson, would they take business away with them, so your revenue would be lower under that situation? Would you have to replace a person with multiple people? Would there be a change to other operating expenses? So in that without scenario, generally the value after you assess these different quote unquote damages would be lower. So it's really a comparison between the value with the asset in place and the value without the asset in place. So here what we're looking at is generally we're holding to the time period of the non-compete. So if you have a three-year non-compete agreement, you're generally looking at a 3-year term and making the assessment over that 3-year period. So lastly, we'll talk about the excess earnings approach. And this is the one that, conceptually might be a little harder for people to grasp. It's very similar to a discounted cash flow analysis where you're projecting, essentially earnings out into a future that would be developed by the asset. But instead of making adjustments for non-cash charges and working capital changes like you do in a DCF, you really have this concept of contributory asset charges or economic rents. So if you think about your business forecast being the return to all the assets that you have to run that business, these contributory asset charges are deductions from the free cash flow to essentially remove the return for those assets from the cash flow stream. So what's left over is the excess earnings related to your specific asset. So generally, when you're looking at an excess earnings approach, the common intangible assets would be net working capital, fixed assets, assembled workforce. If there's a trade name or technology, you would take out returns from them as well, so that you're subtracting all these additional returns so that what's left over is just the return to the asset that you're valuing. The easiest way to think about it really is just in terms of, if I didn't have these assets and then we had to go out and rent them, what sort of return would I need to get to these assets? The other important assumption here is the customer churn rate. So again, just similar to obsolescence, when we're looking at it, the value of a customer relationship, for example, you're looking at it at that point in time. So the expectation is that you're not going to keep a customer forever. If you think about like the cell phone industry, a typical churn is 25% of their customer base on an annual basis. So you want to make sure that as you're valuing just the customer base that was acquired, you're accounting for that loss of customers over time. So you're really looking at a decrease in the value, so a declining revenue stream, as you're looking at the value of that asset. And that delta between the customers that were acquired and new customers coming on board essentially is what falls to goodwill.
Hey, Jason, we have a question from the audience. Do you mind if I ask it to you?
Of course.
The question is, intangible valuations under business combination, how to determine useful life and subsequent events, i.e. phasing out a brand name intangible during a rebranding initiative?
Yeah, so in terms of remaining useful life, there is some guidance out there. So it's really one of two methodologies. So if it's a contractual relationship, like I mentioned with the non-compete, the useful life would be that contractual term. Same thing if you're valuing a contract and you have a 10-year contract, the amortization period would be that 10-year agreement. When you're looking at something like the customer relationships, where you're looking at a pool of customers that will, essentially decline over time, the methodology used is you're really looking at when the majority, how long it takes to the majority of the value is achieved. So for example, if you have a customer relationship and you're projecting out 20 years of cash flows, the year in which you achieve 90% of your value, so say that's year 12, if you sum up years 1 through 12, divide that by the total value of your relationship, and that's 90%, then 12 would be your amortization period. There's definitely not a hard and fast rule, but there is some guidance out there. And it's more general that it talks about 85 to, I think, even 95%. So a pretty broad range in turning and how you would assess the remaining useful life.
Well, thank you, Jason. We appreciate the feedback. Well, I think that brings us to the end of our session today. Thank you all so much for taking the time to join us. Thank you also to my colleagues. They've put in a lot of hard work behind the scenes in preparation for today. We hope you all found the discussion both engaging and educational. Riveron is very thankful for our relationships with you all, and we wish you continued success and continued acquisitions in 2021. We look forward to meeting you again on May 6th, which will kick off our SPAC and IPO series. So please keep an eye out for that invitation. And thank you again and enjoy your day.